Welcome to a few minutes on the markets with M&K. We wanted to take a couple minutes here today just to give you an idea of how we are thinking about the markets with everything that's going on out there. First and foremost, everything we say here today is for informational purposes only and should not be considered advice. Let's jump right into it. We've had a lot of turmoil lately. We've got a new president in office, and I think a lot of people are kind of wondering, what does this mean? Well, if we go back to 1928, what this first chart here shows is the first year of the president's term. What is the average performance, kind of looking at it by quarter? So we've got the first quarter here on the bottom left. And what we see is that on average, over the last almost 100 years, the first year of a new president does tend to be a little rocky. So we believe that this has to do with just pure uncertainty in the markets. We often talk about how markets don't like uncertainty. Many would say that we have more uncertainty today than normal, but nonetheless, when we get a new administration in, it does tend to be the case that the markets sit back and kind of wonder, what are they going to do? And so from that standpoint, I think you could make an argument that we even have a little bit extra uncertainty today with the tariffs, with DOGE, with all the different things going on. But to some extent, we would argue this isn't that abnormal from a historical perspective. Another way to look at this is to say there are 16 quarters in the 4-year presidential cycle. So going back to 1950, if we look at the average of each of those quarters and kind of stack them up against each other, the first quarter is the second worst average performance of the 16 quarters. In fact, we've only seen about 0.1% increases in that quarter on average, and the market's only been up about 55% of the time. So again, going back to uncertainty is kind of the driver of that, in our opinion, and we have seen a little bit of extra uncertainty this year. But as much as we all like to, talk about who's in the White House, to some extent, we would argue it doesn't matter that much. And we think this chart shows this maybe better than most. Going back to 1896, over 125 years of history here, we can see every president that we've had in office and what was the annualized return off to the right of their time in office. We can then see off to the far right how they ranked among each other. What sticks out to us when we look at this chart is that 4 of the top 5 ranking presidents of all time from an annualized stock performance standpoint have been recent. Bill Clinton, Barack Obama, Donald Trump, Joe Biden. Even before Clinton, you had George H.W. Bush in 7th place. I think it's pretty easy to argue that going from Barack Obama to Donald Trump to Joe Biden is a huge swing from a policy standpoint. So to some extent, we would argue there are bigger factors often at play in the markets and in the economy from that standpoint that we're not necessarily willing to just put our foot down and really think that who's in the White House matters a whole lot from a markets standpoint. Moving forward, we do want to kind of talk about just volatility in general to kind of put a little bit of the pullback that we've had here recently into perspective. Going back to 1980, what you see here on the chart is in the blue bars, the S&P 500 annual return for that year. In the gold boxes, you can see what the max pullback was in the given year. On average, we see about a 14% decline at some point in the year. But in many cases, like you can see here, you've seen some pretty decent pullbacks with the blue bar still finishing the year in positive territory. So pullbacks are absolutely a natural part of investing. We think it's a healthy kind of reset at times of expectations and whatnot. But if we look at it this year, we have seen a pretty good sell-off here to date. So we have dropped, if you kind of look at this next chart here, we're looking at the S&P 500 total return going back 20 years. And what this really shows isn't from a calendar standpoint, but more just from the highs. So anytime you see this chart dropping or the line dropping here from that 0% level, it just means we're falling from the high. And how far did we fall at any given time? And so on average, when the market's coming down from its highs, it'll fall a little over 7%. To date, we've fallen a little over 9% currently. So we're a little bit above average, you could say, on the drawdown here in the markets. But in many of these cases, when we've seen these big drawdowns happen in the past, it has been a buying opportunity. So if we do kind of mark some of these drawdowns, in fact, that go beyond the average, historically, those have been pretty decent buying opportunities. Another way to think about this is from the VIX, or the volatility index. This is kind of a way to measure uncertainty in the markets. Right now, volatility, as measured by the VIX index, has been spiking. We recently hit a reading of 27, I believe it was, late last week, currently around 24. These are definitely elevated levels for volatility in the market. If we look back to where these other high peaks really peaked out, and then looked forward from there 6 months and 12 months, we're positive almost every time. There were a couple of periods here in 22 where we definitely had a lot of starting and stopping, kind of in the middle of it all. But nonetheless, most of 22, had you been a buyer when the VIX was really spiking, looking back today in 2025, they were good buying opportunities. Usually what we see is that these spikes here will correspond with these big sell-offs in the same time period in the total return of the S&P 500 from those highs. Another way that we think about this is with sentiment. Just how are people feeling about the expectation for the next 6 months? And so there's a survey out there, the AAII survey, that really tries to take a poll of the sentiment of investors. And what they've shown more recently is that we're all the way down to only 19% of investors feel bullish about the next 6 months, or that they believe a positive return is ahead. Whereas 57%, and actually as of late last week, we hit over 60%, felt bearish, or that negative returns were waiting on us in the next 6 months. And so the reason that's important to us is, historically, when we see sentiment shift this much negative, it has been a pretty good buying opportunity. So we are not stressing out too much at this point about the sell-off in the market, or even just this huge sentiment swing. We probably, in all honesty, get a little more nervous when it goes the other way and everybody feels really bullish, because that's probably a little bit more worrisome to us than when it really hits this extreme bearish level. Like we said, historically, this has been a pretty good buying opportunity when you do hit these peaks, if you will. And so that 60% reading was the 7th highest going back to 1987. So we haven't seen a whole lot of instances going back to 1987 where you've had this many people feeling negative about the next 6 months. Another way to look at this is, I think this is a little comical, but CNBC will often run, going back to 2010, a special where they'll have up there on the screen something about markets in turmoil. The news loves to sensationalize everything, as we all know. And what we think is a little entertaining about this, I guess you could say, is that, number one, look at how many of these instances there are going back to 2010. But next to the dates, you can see where was the S&P at that point in time, and then what was the return in the next 12 months or the next 1 year, and then what was the cumulative return since then. So what really sticks out to us on this is that you only see green when you look at this chart. Now, I will say that we have not seen CNBC run this quite yet. So the last time they did this was May of 22. But there's part of us that's kind of expecting this isn't too far away, unless they've got wind of this chart floating around out there, and maybe they'll come up with something a little bit different. But the market's been up on average 40% over the next 12 months when you start to see this kind of sensationalizing in the news on the markets being in turmoil. So kind of interesting to kind of think about it. But when the news is really making you think that it's just awful out there, it tends to be pretty good returns in the following 12 months. Another way to think about this, when we really think about the long term of investing, which is how we want everybody thinking, it's how we think. We're not too focused on what happens in the next week or even the next month, but we truly are looking for good long-term investments for folks. If you look at the last 20 years, and we've already seen all the different spikes in the VIX over the last 20 years, we've seen the big drawdowns for the market over the last 20 years. But had you put $100,000 invested in the market 20 years ago, today you would have something like $680,000. So to us, the moral of the story is stay invested. Maybe take some of these time periods when we do see this rise in volatility to maybe make a few adjustments to our portfolio, maybe make sure that we've got our favorite ideas in there, things of that nature. But, we think the moral to the story is to stay invested for the long run. There's an old Wall Street saying that the stock market is the only place things go on sale and everyone runs out of the store screaming. So we want to make sure that we're not being those people who, as things go on sale, we all take off out of the store screaming. We don't have a crystal ball. We don't really know what lies ahead, but we do know that historically speaking, when we get everybody feeling so negative, it tends to work out for us in the long run. And so with that, we do want to say thanks for listening. We hope you got something out of this. If you have any questions, don't hesitate to reach out. We're here for you and look forward to seeing you soon. Thank you.